Is it possible to use candlesticks in trading, or are they just a trap? And if so, how can you use them in your trading to improve your performance? Alright guys, welcome to this video, and today I want to talk about candlesticks because recently a lot of people have been telling me that candlesticks are a trap, that you cannot rely on using them. I totally disagree because I use candlesticks myself and I am profitable, so that's why I disagree. However, I do I do understand why people say that candlesticks are a trap, because usually people look at it in the wrong way and they get trapped on the wrong side of the market, which causes them to lose money. So in this video I wanted to talk about the candlesticks I pay attention to, and potentially how you can use those candlesticks to improve your trading. So let's dive into it. So one of the candlesticks that I pay attention to is an inside day. For those of you that don't know what an inside day is, let me first put the lines in. So this particular day is an inside day. And this means that the range of this day, so the high and the low, are within the range of the previous day. And that's exactly what happens here. As you can see, lower high and higher low. So that's an inside day. And what's really interesting about those days is that there will most likely be some liquidity trapped on both sides of the range, so below the low and above the high. This mostly depends on the location of the inside day, but in general that's the concept. And I know back in the day a lot of people were trading inside days to because there was liquidity on both sides of a range, and they would basically try to trigger one side of the range to trigger stop orders. And this concept can still be used today. However, the way I use it is a bit different because I wait for a break. I don't trade towards a breakout of a certain area, but I wait for the break and then I want to see what happens. So let's go to the hourly time frame. So this is the inside day, and as you can see, once the inside day high gets broken, so the blue line over here gets broken, you can see a violent reaction back into the range. And what's also more important is that it took out multiple highs. So these highs got taken out, the inside day high got taken out, and there was a very strong rejection. I mean, look at the candle, look at this close. It's very, very bearish, and especially if you know the location, because candlesticks on its own aren't really that telling. But if you look at the location, so the inside day high gets broken, so there will be some buyers that will be buying. There will also be sellers that get stopped out, which is forced buying. And then also this high gets taken. So in general, there will be liquidity being triggered on the buy side. So there's a lot of people buying over here, but there's no follow through. There's a close, a very bearish close, and that's very telling to me. And then usually I trade to the next structure low, because that's the area where there will also be some liquidity, not as much as here, but this will be the area. So a couple of ways you can trade it. First of all, you can directly enter at the close. Then you would have made around a 3 or a bit lower than that. You can also wait, and a lot of people do this, wait for the price to go back into the range. So like this, price goes back into the range, and then wait for a retest of the upper level of the inside day, potentially go short. On this time frame we didn't get a retest. Let me check the 5-minute chart, because I know a lot of people traded on the 5-minute chart these retests. Let's see, no, not a retest at all, because this was the particular day and there was no retest. Well, a very, very small one, but you had to be quick. So this is what I look for, inside days. And then what I look for, what happens once one of the sides of the inside days get broken, and preferably I want to see multiple highs getting broken, rejected, and then I want to trade that direction. So that's one of the candlesticks I use. Let's see if there's another example. Yes, we have over here. Let me put in the lines. There you go, another inside day. All right, so let's go to the Avaly to see what happens on that particular day. So we had a very strong move to the downside. Then we got some consolidation, and this is the high of the inside day. And this candle is the low of the inside day. And as you can see, once the high gets broken over here, once again, very, very violent move back into the range. And again, the last low gets broken, and that's where your target should be. So it's a very easy concept. Liquidity is being trapped here and here. And you want to see what happens once one side of the range gets triggered. And once again, you see very, very bearish price action once liquidity gets triggered above this range. Very, very bearish. And that, to me, tells me to go short. Let's see if I can get back to the 5-minute chart. Again, a lot of different ways to trade this. You can also use it as a bias. So, for example, you know stops are above this high. And then you get a bias once the price goes back into the range, which is over here. You now have a short bias. You're going to target the lower last important low, which is this white line. And then once price breaks back into the range, you can go short. Maybe put your stop over here. Again, it's up to you. You need to test it out. I place my stop over here because I want some room. And I enter once we get back into the range, but it's totally up to you how you're going to trade this. So as you can see on this particular setup, I would have made around 3.7 R. And these setups usually work pretty good. My strike rate is around 55% on those. And if your risk reward ratio is well over 3, you basically have a very, very great edge. What's also nice to see is that this is quite a nice flip zone. So we first had resistance, then became support, multiple touches, and then a break to the level. As you can see, the first break caused a bit of a retracement, but that doesn't matter to me. So that's how I enter, but you can also be more conservative, wait for a break below, and then potentially enter on a retest. I don't like this because there's usually a lot of violence behind the move, so you don't really get as much retests as you want to. So I prefer to enter at the break back into the range. It decreases your risk reward often slightly. But I'm willing to pay up just to enter the trade. I also know a lot of people that target the lower blue line, which is something I used to do, but I noticed that I got a lot of retracements before making my target. As you can see here, target is almost hit and then retraces entirely back to the upside before hitting target. And I don't want to be sitting out this entire move, and especially because there was a false break out of this important low that was in the way. So Now I trade towards the most important low on the chart. So yeah, I hope you guys learned a lot from this video. If you have any questions, please leave a comment below, subscribe for more videos, and let me know what you think of this concept.